For silver, I think that if you look at the technical analysis, it created a beautiful range between 29 and 22. 29 being the resistance, 22 the support. If it can go above that resistance at 29, it goes and does a move that's $7 worth or that range worth on the other side. It's going to 36.
Hello, silver fans. This is T, and you're in the place to be for silver education, acquisition, and entertainment. Hey, thanks for watching, everybody. Ladies and gentlemen, Lior Gantz, who is someone who has a global perspective. He keeps his eye on macroeconomics, and well, we Americans are distracted by Bud Light memes, Ron DeSantis, and what's on Netflix.
I'm back, baby.
Ow! Ow!
That's what you get for being sentimental.
Lior can fill us in on what is going on around the world that we should know about. But first, let's start right here at home with our very own debt ceiling. And we have our perspective, but from someone who is outside of our country. Lior, what do you make of this debt ceiling and the pissing match that's going on in Congress?
Yeah, first of all, around the world, the U.S. debt ceiling is not a big event. It's not something that gets covered daily on financial media or otherwise. It's literally discussed as, hey, the Americans are doing that debt ceiling theater again.
Yeah.
So I can tell you, like, from the perspective of global money managers, it's not like within the U.S. where it's a big event for Wall Street and for the gold community, etc. But outside, on a macro perspective, other politicians, for example, they don't view this as a big important event. So it's a really financial event and not something that has a big scope like interest rates, for example, which do impact everyone, or regional banking, etc. So I think that what's happening and what will continue to happen in the next few days is you'll have this resolution. The debt ceiling will be raised, and I think that what's most important is that with higher interest rates and very high inflation that will continue into 2024, the elections will be about fiscal responsibility, and that's first for, I don't know, since the 80s, when debt or fiscal responsibility was talked about because of the of everything that happened in the 70s. So that's a good thing. The problem, part of solving a problem is to acknowledge that there is a problem, and because America was under such a muted inflation for so many years because of hyper globalization, because the Soviet Union collapsed, commodities were getting sold off at pennies on the dollar for 30 years. People were moving around. There were so many arbitrages of salaries, like you can outsource everything to Asia, Latin America, etc., and continue to live as if there is no inflation. And right now, when you're paying the price of deglobalization, and you see that there is a price for commodities, there is a price for supply chains, etc., then I think the fiscal responsibility is happening around the world. I don't know how much this is being covered in America, but in France, they just raised the pension from 62 to 64 years of age. And that was a huge event for them. The French view their pensions and their lifestyle as almost sacred. So
yeah, I did see that, and people were, pissed off about it, rioting in the streets, and I guess I can understand that. Here in America, we work basically till we die, practically, but there, if they basically got the rug pulled out from underneath them.
Exactly. And in France, about 50% of GDP goes towards retirement. So they have a retirement culture. In other OECD nations, it's about 8%. So they love retirement. They think of retirement as part of the natural course of life. So to push that by 2 years, that was a very tough decision for any politician to make, and obviously it was because the way they're trying to balance the books with higher interest rates. So I think that with the debt ceiling, the most important thing that will happen with the debt ceiling is that it puts to the front stage fiscal responsibility. And I think that in the United States, you will see in the next few years, you will see presidents getting elected with their fiscal plans. I think that you will start to see how the governments try to move around the big expenses, which are Medicaid, Medicare, defense, education, and Social Security. And I think that within that, you'll have a whole debate about taxes, who should pay less, who should pay more, etc. I think that these things will be very important. And on top of that, of course, the main issue will continue to remain China and how to deal with China. So in terms of hedging or anything that has to do with what you can do personally, I don't think that that raising the debt ceiling is introducing any sort of new risk to the table, because everybody understands that the situation is unsustainable. You cannot run deficits to perpetuity, and certainly not in a world where America is exiting the role of brokering peace and democracy around the world. It's just there is a vacuum that's being created, and that plays into the role of reserve currency. It's not an acute, imminent threat that any other country will come in and become the reserve currency, but this vacuum certainly creates a trend, and that trend is that America no longer wishes to be the policeman of the world, and it wants to focus more on China, and that vacuum, it will create less demand for the U.S. dollar on aggregate. So I do think that in the next 5 to 10 years, you will see less use of the dollar as the reserve currency. I don't think it will get dethroned, but less use of it does mean that we're in this transition period. And because there are no other candidates, I do think that central banks and more retail will turn to gold and silver.
My viewers are savvy enough to know that, gold and precious metals, it's a long-term play. Where do you see, gold going in the years to come?
With regards to gold and silver, I think that what you have is a situation where these higher interest rates are going to drive money out of the United States and into emerging markets. And that in turn is creating a bear market for the dollar, because in the zero interest rate days, you wanted to be part of Silicon Valley because that's where the growth was. Now the growth is going to be very slow and the risk very high for the startups, for venture, for tech. And with big tech going through these big changes with generative AI, I think that money's flooding out of the United States, going into Europe, going into Asia, and that creates a bear market for the dollar. Therefore, I fully expect two things to happen. One, I think that once gold breaks above its all-time high of 2,067 an ounce, I think it's going very fast, meaning on a rally to 2,450.
Okay.
And after 2,450, it might settle and consolidate a bit because obviously a lot of traders would like to lock in these profits, but it's going higher. It's going towards the 3,000, and I don't know if most of your viewers know this, but if you're subscribed to Wealth Research Group on the newsletter, I just presented. It's a free newsletter, and I just presented a few charts that are incredibly interesting. One is the gold to S&P 500 ratio. So gold right now is trading at an all-time high compared to about 80 fiat currencies. So it's in a raging bull market if you denominate it in fiat. But did you know that it's trading at a 123-year low compared to the S&P 500?
Wow. No, I did not know that.
So historically, from 1900 till 2023, the last 123 years, the average is that 1 ounce of gold is worth about 1.6 points of the S&P 500. In other words, if the S&P 500 is trading for 4,300 today, then gold should be at 6,900.
That's incredible.
That's the 123-year average.
Mhm.
Now today, with 4,300 being 1 point of the S&P and 1,950 being an ounce of gold, the ratio is less than 0.5. Historically, gold will have to triple from here if nothing happens with the S&P 500 just to go back to its long-term average. I think that most people don't really understand that we've been in this bear market for gold compared to equities for a very long time. Even though the gold has outperformed the S&P 500 in the 21st century, because of the roaring 80s and 90s, it's so skewed towards equities. And now with higher interest rates, I think that this will start to look better, because here's the thing: stocks are not cheap compared to bonds. But then you look at bonds compared to gold, and you say to yourself, okay, well, if stocks are expensive compared to bonds, where are bonds compared to gold? And compared to gold, bonds are really expensive right now.
Mhm.
So you have stocks as the most expensive, then bonds, then gold.
Right.
And then you look at gold and you say, well, silver is super cheap compared to gold. And then when you look at the HUY or the GDXJ index compared to gold, or mining stocks compared to the spot price, that's trading at an all-time low.
Sure.
So the mining stocks are the cheapest of the cheapest. If you look at like an axis, you have mining stocks, silver, gold, bonds, stocks.
Mm-hmm.
And that's the world we live in today. And like I said, I don't think that dynamic will change for a few years. So that's why I think that gold is going a lot higher. Silver in turn is going to go a lot higher. And this is all predicated on the DXY index, the dollar index, falling below 100 and then falling below 90. If that is your key to knowing how aggressive you should get with precious metals or precious metal equities, options, leverage ETFs, or just more concentrated bets. Because if the dollar is going below the 100, that's good territory. If it goes below the 90, then you're in a phenomenal place. And I can tell you that this gold bull market that we're on right now is not a retail craze. Ask your bullion dealer,
Mm-hmm.
and also look at ETFs. This is not your retail mania of 2011 at all.
Right.
You're just not there. People don't have faith in this bull market, and in a bull market for in the later stages of a bull market for precious metals, silver outperforms by an incredible amount, and it's just not doing that. It's not even at 30 an ounce. So,
Right.
I mean, so early on. For silver, I think that if you look at the technical analysis, it created a beautiful range between 29 and 22. 29 being the resistance, 22 the support. If it can go above that resistance at 29, it goes and does a move that's $7 worth, or that range worth on the other side. It's going to 36. Well,
as a silver stacker, that's music to my ears. I'll tell you that.
Well, I think that as a stacker, you have a different approach than as a trader.
Mm-hmm.
Commodities are very boom and bust,
Mm-hmm.
as you know. They're boom and bust by definition.
Mm-hmm.
So a stacker is trying to create a very unique dynamic for himself, because he's trying to collect more and more of a commodity that has boom and bust cycles.
Mm-hmm.
So for him, if you're just stacking, what you should want is for your income to rise, so you have more savings power, and that savings power can be converted into more ounces, because you want to collect more ounces.
Sure.
As a dual, in other words, what I do, which is stack the physical, trade the the underlying equity,
Mhm.
what you want is the best of both worlds. So
Sure.
in a bear market, you want to collect more physical, and in a bull market, you want to enjoy the trend, and exit because it's a boom and bust mentality. So yeah, for stackers, I think that obviously you want to stack as much as you can before big rallies,
Mhm.
and for duels or those that trade, I think that if you can be patient and wait until you get that confirmation that the dollar is weak,
Mhm.
and I think you will get it towards September or November when the Fed perhaps pauses, perhaps starts talking about cutting. That will be the golden era, pun intended.
Well, Lior, you are an absolute wealth of knowledge. I will put links to your reports down in my video description, and encouraging my viewers to click on them, check you out, and learn more. I have a feeling we could go on for another hour or two, but we're going to say goodbye right here. Thank you so much for your time.
Thank you, sir.